Well, good morning, everyone. It's Wednesday, November 13th, and the theme of today is I hate to tell you that I told you so. Remember, everybody last week was thinking that Trump and China were going to work things out. Stock market was making new highs. You could see here the S&P was rallying and huffing and puffing, and I was telling you, please, please, please be careful. We're not even close to finalizing anything. Don't rush to judgment. Stocks are overbought. They've been overbought since the 4th. Today is the 13th. That's how long the market has been stretched out. Now, news came out overnight. I got to say, President Trump, he's something else. He's telling China now, he's going publicly and saying that if they don't complete phase one, if they don't agree to further negotiations, he's going to increase more tariffs. I mean, why would you do that when you're just starting to negotiate and make progress? Stock market did not like that. We're down about 0.29 overnight, and it looks like we're going to start moving a little south. Sentiment is definitely changing based on that. It's basically telling us that he wants to play hardball, and he's really not willing to negotiate in terms of what real negotiations is like, and I think that's going to push the market lower. Now, I on one hand, he's amazing. He's a tough negotiator, but maybe a little too tough, you know? I mean, give China a little break, like get into phase one and then give like a warning, but I'm not the president. But basically what it did is it completely changed the sentiment of the market, and now people are a lot less wary of whether or not this trade war is actually going to complete phase one. Trade war negotiations are going to complete phase one. So again, we got a lot of Fed data today, a lot of Fed data. We got CPI coming out in about 22 minutes. We got our friend Jerome Powell from the Fed, who already lowered rates 3 times this year, speaking. Frankly, I don't think Fed data is going to be driving the market. Why? We already know the Fed's not going to lower rates anymore this year. They've already done it 3 times. Even the bond market is not reacting to it. Let me show you. Remember, when Fed lowers rates, it causes bonds to go higher. Well, look at what happened the last time. Let me get rid of all of this data here. Look at what happened the last time they lowered rates. Rates are supposed to go, bonds are supposed to rally. They trade inverse to interest rates. So when interest rates go down, bonds go up. We had 3 rate hikes. The first 3 rate drops. The first drop took us from here to here. The second one took us from here to here. And the third one took us from here to here. It's priced into the market, folks. It's priced into the market. That means there's very little the Fed can do at this time to prop the market high. They could do certain things. They could, if China and US resolve their differences, they could maintain low rates. That's one thing they can do. That's if China and US resolve their differences. Or they can keep telling us right now they're going to keep lowering rates till what? We're already close to lowering. So you see the Fed, the markets, the bond market is not reacting as much to Fed. And that's not kosher. Now, remember what you just saw a minute ago? You saw the S&P 500 peak out about the 4th. And that's when I started telling you guys around the 1st, around the 4th. It's kind of like right here that the stock, right when it was making new highs, I said, folks, the stock market's overbought. Don't buy right here. I want to show you something eye-opening. This is momentum levels, all right? Let's get rid of all of this. Let me show you. This is, I want you to pay attention to this because this is really eye-opening. Let me actually, I don't even need the moving average for this. This is momentum levels. This is the percentage of stocks in the S&P 500 trading above the 200-day moving average, the benchmark for whether the market is bullish or bearish. Now, on the 4th, 9 days ago, not 9 minutes ago, not 9 seconds ago, not 9 months ago, 9 days ago. So you had plenty of time. The momentum level was at 73.80. That meant 73.80% of stocks in the S&P 500 out of those 500 stocks were trading above the 200-day moving average. Let me for special effect, let me put the 200-day moving average here. Where's my moving average? Come on, moving average. Don't hide from me. Where are you? Where's my moving average? Did I miss the moving average? The old moving average? The one that we have all of these different moving averages here. The regular moving average. All right. Let's put the 200-day line so you can see right here. Now, this is the percentage of stocks. Out of 500 stocks, we had 73, 74%. Notice every time we've come, and let me go 3 years. This is 3 years. Every time we go to about 73, 74%, we sink lower, below the 200-day. So in this case, I told you guys that on the 4th, 73% of stocks. Now, here's what you need to know. Since the 4th, look at the stock market. This is the 4th right here. Now look at price. It went from 307.40 to about 310, okay? Price went, pay attention. This is eye-opening. Price went up on the S&P 500. Went up from roughly 307, let's say 308 to 310, but it went up. I want to show you this. Momentum levels went down from almost 74% to about 70%. What does that mean? Why am I making such a big deal about it? Well, let me explain to you. Pay attention. This is really important. Imagine you're driving a car on 8 cylinders and it has 250 horsepower and you're driving 20 miles per hour. Well, you're still driving 20 miles per hour, but the engine is braking, and now only 6 cylinders are moving. The engine's going to drive harder. It's going to push harder to maintain that 20 or 25 miles per hour, right? That's what's happening with the market. You have less stocks driving the market higher. Less. And this is not a theory. This is a fact. I'm looking at the numbers. 74 to 73.8, 97 to about 70.16. That's substantially less stocks driving price higher. That's called narrowing of momentum, folks. And that typically happens right before the stock market begins to rally. Now, when that happens, the odds are right now, as you can see here, we peaked. We came to about 74, 75. Every time we do that, the market cools off. Doesn't go really low, but cools off. And when you take that into account, where the overall stock market, the S&P, 70% of stocks over 200-day moving average. If you look at the broad market, at the overall momentum on stocks, and this hasn't changed, it's about 55%. So the S&P is super bullish while the overall market is barely bullish, and there are stocks now that have less momentum in the S&P. The momentum in the S&P is actually cooling off, but since the 4th, price has been going higher. So we've been seeing this for several days. And if you look at my videos over the last few days, I've been telling you about the moving average, not about the moving average, about momentum levels, about narrowing of momentum. And so I hate to say I told you so, but I told you so. So what do we do about this? Bonds. Here's what you need to do. You need to right now focus, for a little bit, you need to focus on assets that are not correlated or have an inverse correlation to the stock market. Now, the bond market is great right now. It looks like it's about to rally. Gold. Gold is, notice, gold is up 42 right now. It's at the lower end of the channel, and it looks like it's going to come up right at the top of the channel. And when it's up at 144.90, I'm going to say I told you so, because the S&P is going to come down, gold is going to come up. You see, it's a picture, and you can read and understand and gauge this picture if you look at momentum levels, if you look at different market sentiments, and if you look at different levels. So I'm expecting gold to rally and possibly some currencies to get involved too, because I think the S&P 500 is going to be hitting the 200-day moving average over the next 3 weeks or a month. And that means it's time to get into gold and currencies. Gold and currencies don't have any correlation to the stock market. As a matter of fact, one better, they have negative correlation to the stock market. And that's amazing, because if you have a portfolio, you don't have to liquidate it. You can stay in it. And there's a way to trade gold, GLD ticker symbol, and currencies like FXE. For example, using the same account. And right now, I got my eyes on gold. So I've created a strategy. Pay attention. This is important, folks. I created a strategy that you could trade gold and currencies in the same account. In the same account that you could trade stocks. Same account. Don't have to go to a futures broker. Don't have to go to a gold dealer. Don't have to go to a currency specialist. Same account. Click the link below to learn more. I think it's really cool. You're going to learn a lot more. Remember, gold and currencies and bonds are not correlated or have an inverse correlation to the stock market. And right now, with the S&P about to head to the 200-day moving average, I think gold is a really, really good buy. Short term, swing trading. That's what we're here for. I'll catch you guys tomorrow. Don't forget, click that link below and check out the video about gold and currencies and how you could trade them in the same account, and there's no correlation with stocks. Oh, I love it. Talk to you guys soon. Bye.